am going to project our presentation. Matt Kramer, are you with us?
I am. Thank you, as always, Michael, for putting together this timely and informative real estate conference. My name is Matt Kramer. I'm a real estate transactional attorney with the law firm of Weinberg, Wheeler, Hudgens, Gunn, and Dial, with offices in Miami, where I'm located, as well as Atlanta, Orlando, Las Vegas, and Birmingham. My clients range from buyers and sellers of both healthy and distressed real estate transactions of all asset types. I also represent institutional and non-institutional lenders, as well as note buyers and sellers. We have a stellar panel this morning of industry leaders in the multifamily space throughout the country. It's my pleasure to introduce the panel to you. We've got Danny Katen, Tony Barkin, Nate Klein. If you all will spend a minute or so introducing yourselves, that would be great. Danny, we'll start with you.
Thank you. Thanks, Mike, again for putting this together. So my story starts about 2009. I started buying single-family houses.
Danny, can you speak into the mic where your voice is a little bit low?
Yeah, sure. Apologies for that. I started buying single-family houses in 2009, one at a time, and we slowly but surely built the platform. Eventually, we had 400 single-family houses and 400 small multifamilies. We pivoted out of that into large multifamily, and we've been residential guys since we started, because one of the things that we learned in 2009 is that workforce housing basically survives any recession you throw at it, right? We are very, very comfortable with the asset class, and right now we're expanding our platform to include additional investors. We're buying in the Southeast, Class B properties, and we're basically cash on cash driven, light value add platform that concentrates on delivering what we say we're going to deliver. So we have a lot of conservative underwriting. We are right now in the middle of a deal. We're closing a deal in Jacksonville, and for the last couple of years, we've been very exposed to South Florida and the Florida market.
Thank you, Danny. Tony?
Sure. Hi, my name is Tony Barkin. I'm the founder and CEO of Allagash Partners. We are a company that is focused entirely on working class housing. We look nationwide. I hate to use generalities because we're talking about trillion-dollar markets, and obviously the specifics make a difference. So it's always hard to do it in two sentences. But basically, what we do is look for good quality neighborhoods in thriving secondary markets. We look for the underperforming properties, which generically you could qualify as existing as Class C, although that's a little distracting because Class C, for instance, in Norfolk, will look very different than a Class C in New York City or Chicago. And then we do significant value add and bring them back to really where they were originally, which was kind of Class B properties with wide rent ranges that offers significant economics for the properties. We offer our services in the form of multi-property funds rather than single property investments, with the idea that we can combine the sponsor role with the fund manager role, thereby enabling investors to get diversification within obviously a very targeted asset class. And we've been doing that for years. My partners and I have over 100 years of experience.
Thank you, Tony. And last but not least, Nate, if you could spend a minute or so on your background. Thank you.
Nate, you have to unmute yourself.
Sorry about that. Here we go again. My name is Nate Klein. I'm a founder and one of the 3 partners of One Wall Partners. We also are focused entirely on workforce housing. Our business is specifically in the Northeast. So our footprint runs from Boston to DC. Current portfolio of about 4,000 units is located in New Jersey and Pennsylvania, and we're very active right now in Connecticut and Northern Virginia and Maryland, and also our existing markets. We are vertically integrated, so we have our management company as well as our investment side of the business, and have worked with a whole host of different investors over the years, running the gamut from high net worth up to very large institutions. We do 2 forms of investment. One is the preferred income fund, which offers some of the diversification benefits that Tony was talking about just a minute ago, as well as providing, because it's focused on preferred equity, probably the safest equity position possible in the sector that we've chosen to invest in. And then naturally, by focusing on these sort of Class B Goldilocks assets in major employment centers around the Northeast, we have a very wide supply-demand imbalance for the assets that we offer, and we're able to do moderate value-add work at a very high ROI, while still maintaining the affordability for the resident base in those communities.
Thank you, Nate. Nate, can you speak more about why you have focused on the Northeast and how this region is holding up as compared with the rest of the country?
Sure. So, one of the main reasons we focused on it initially was that it just sort of has a bad stigma and bad press associated with it relative to the rest of the country for real estate investing, and we thought there was some opportunity in being contrarian. The market's characterized by a lot of longtime independent operators, mom and pop type folks, unsophisticated, non-institutional ownership, which created, we thought, a lot of opportunity for coming in and doing a better job of managing these assets, and then applying more sophisticated business plans to them. So we, alongside of that, obviously focused on the macro and micro benefits within the individual markets in the Northeast. And while you might not see as a region some of the headline population growth metrics that you see in other places, they're basically dealing with the most acute affordability issue, which fits into our strategy of identifying these assets that are close to the major employment centers, either on the outskirts of towns or lifestyle advantaged places, suburban secondary markets, that sort of thing. And within those areas, there are micro trends associated with the demographics of the populations, whereby although you see some migration patterns out of the Northeast, it's mostly high income folks leaving high taxes and moving to Florida, that sort of thing. Whereas you have this built-in group of middle class individuals that are tied to their communities, whether because they don't have job mobility or because their families are there, or for a multitude of reasons, that create a ongoing demand. And then you also have, as opposed to the rest of the country, a very difficult affordability challenge as it relates to buying a home, and difficult development from the standpoint of new apartment operators being able to compete with existing assets. So we saw that the basis discount that we were able to enter created that upside opportunity for the renovations, and just had this constant flow of demand from a whole host of different renters within the Northeast.
Thank you, Nate. Danny, why are you focused on the multifamily sector now?
Well, again, it goes back to our experience. In 2009, when there was no light at the end of the tunnel, we saw how resilient residential was. We were buying properties for $70,000 that were worth $300,000, and the rent went from $1,500 to $1,400. So that created a very good experience on what we were able to do in returning capital, and most important, cash on cash to our investors. And I think that when times are uncertain, cash on cash becomes very important for people. We believe that, working class rents are a basic need. I will even argue that it's more even basic than food. Food, you can always go to a food bank and you'll be fed. But a lot of people are in the streets right now because they cannot afford to have their own place to live. So I think that shelter becomes almost a primary need. But one of the things that we really like about this, and I started about writing about 3 years ago about the effects of technology in real estate, right? So what will happen with a gas station where all the cars are electric, right? I started saying about a couple of years ago, maybe in 2025, we'll have the technology necessary for people not to go to the office. And, people are kind of like, well, it never happens. We were going to have to go to the office. And here we go. It took basically a pandemic and 2 months to not go to the office. And the funny thing about this is that technology that we're using, it's probably 10 years old. So going back to basics, it's cash flow that we believe it can be consistent, and most important, cannot be disrupted by technologies that we don't know even exist right now. I think that most asset classes, warehouse, self-storage, industrial office, will be impacted by technology. I'll, gladly, if you can send me an email, I'll send you a presentation on that. But the only one that will probably keep on being the same is it's residential. So I like the consistency of residential cash flows and the fact that it's very resilient in uncertain times.
Thank you, Danny. Tony, if I can turn to you, the multifamily market has a wide variety of subsectors along both geographic and economic lines. Where are you looking for value today?
Sure. Well, I think that, I got to start by agreeing with what Danny Native said, that, about the marketplace. Obviously, multifamily has proven to be, one, going back, the most resilient of sectors in real estate. And two, I think a great provider of income, as well as upside. And today we're faced with a situation where you've got need for housing, I think, as was very well stated, is actually more important than it's ever been, because it represents today not only people's home, but in many cases their office, and at some points in time, unfortunately, I think we have to recognize just a safe haven from things that are going on in the outside world. And so people are treating that. And I think that's nowhere probably better evidenced than in the working class housing world, which has, it starts off with a massive affordability issue because of the lack of development paradigm. You'll notice that none of us here are really talking about developing working class housing. We're all talking about the shortage in it. And I think it's necessary to point out that that the shortage exists because there really isn't a good, scalable, profitable paradigm for development. When we get to subsidized housing, you've got subsidies. And so the subsidies allow for profitable development, even if that's not being done enough for the people who need the housing in that economic band. And obviously there's economics for developing Class A and luxury housing. But when you talk about that middle range of rent performance, it's very difficult given the understanding that you've got a basically set of fixed costs with respect to construction. You've got a fixed financial structure, and you've got a fixed rental. And within that, it's difficult to find. There are obviously idiosyncratic methodologies, but it's difficult to find. And so the strategy of finding cheap properties and adding value and stabilizing them is one that offers really the best. So you start out with why this value add discussion, whether it's light value add or heavy value add. I think value add is the best place to be. It's the one that allows you to most quickly take advantage of the income opportunities of the sector, because you're obviously buying properties that are operating And so there's not that long period of waiting during construction. And then I think it's important to look at secondary markets. I think that, secondary markets, especially ones with thriving economies, are doing extremely well. And, you've got to, even in this pandemic, I think that's really where the focus should be. And it's one that historically the capital has not gone to. So I think that that's where you can go in and you can really find assets that are still very, very attractively priced. So I think that's the value add opportunity in the lower underperforming section of properties within secondary markets is absolutely the best place to focus. And where we still see that you can generate mid to high teens or even higher net returns for investment. So that's basically our focus.
Can I complement something on Tony? And I think that's also very important that we talk about tax efficiency. Multifamily, it's very tax efficient when it comes to cash on cash, because you have the cost segregation that basically provides a really nice shelter for the current income. So at the end, when you're talking about, cash generating assets, if you think about it, you might have a bond that gives you a great yield, but then you have to pay, 40% tax on it. In multifamily, we're trying to, and I guess, Tony and Nate, will have sort of the same target, 10% cash on cash, but that comes sheltered by this huge loss that comes via the depreciation. So at the end, the tax bracket that you'll see on multifamily, at the end, it's only capital gains. And I think it's equally important to talk about the efficiency of multifamily investment.
Well, thank you, Danny. So in discussing high demand for particularly working class multifamily properties as well as tax advantages, another issue driving profit is leverage. And Tony, if I could stick with you for a minute, can you discuss the interplay of leverage in the multifamily sector? How prevalent is it, and how does it compare with other real estate asset classes?
Well, it's very prevalent. I think it's actually really interesting that you point that out, because it is one of the great advantages of the multifamily property sector is that leverage, because of the agency participation, leverage is continuously available. So actually, during the worst periods of time, one of the reasons that multifamily, from an asset class valuation standpoint, we always talk about how well multifamily performed from a cash flow standpoint coming out of the financial crisis. But one of the other reasons that it performed well from a property valuation standpoint is that it could transact with leverage on a continuing basis coming out of that. Whereas other sectors, the way the banks and the financial system was locked up as a result of that, you didn't have the capacity to transact with leverage, and thereby eliminated really some of what would have been opportunistic buying didn't exist. Whereas that opportunistic buying was able to come in, put a bottom in for the multifamily real estate market much sooner, and also then cause the rally in prices back to basically unchanged much more quickly. Really, it took about 50% less time for the multifamily universe to go back to basically unchanged versus the best of the other commercial real estate universes. And so it's not only that we're looking at, we talk about the fundamentals and how important housing is, but from a financial mechanism, the financial system is there to support that. And that's a rational thing. The government probably, if you're going to choose, is it more important that people go visit a retail store, or is it more important that they have their shelter and home and safety? Well, the answer to that seems relatively clear. Obviously, we do need to continue to be able to buy things and have an economy, but their technology can step in a way that technology can't put a roof over your head.
Thank you, Tony. Nate, if I can turn to you, sticking to the topic of profitability in the multifamily sector, you said that you're in the market with a preferred fund. What is the advantage of such a product in the current environment, and have you been able to pay distributions from the fund?
Yeah, so I think that's one of the chief advantages, which is that, we've been in an operation since January and have paid 3 consecutive quarters of full distributions, which I think is probably not likely in a lot of other funds or individual investments, given the pandemic environment that we've been dealing with for the last several months. The design and the reason for that ease with which it pays the distributions is because the capital stack is senior to the common equity within the fund, and therefore it's getting paid out before common equity is getting paid out, and so you're able to size the investments that the fund makes in the deals at a very favorable basis, call it 10 to 15% below the actual asset value, and then when cash flow, even if cash flow declines, such as in a difficult economic environment, there's still ample cash flow to pay the current distributions to the preferred fund.
Thank you, Nate. A question came in from an attendee, and I'll throw this question out to the group. The question is, can you give some color on competition for affordable housing? What is the opportunity set versus the amount of dry powder required? Danny, how about we start with you?
Well, there's a lot of capital on the sidelines, and I think that the competition will only get stronger. A lot of the asset managers eventually they're gonna sit down in a room and say, okay, where do I want to invest my money that I have to give returns to, the life insurance company or the pension fund? Do I want to get it into some asset class that I don't know whether it's going to exist 5 or 10 years from now, or do I want to get it into some basic fundamental asset class that will probably be here forever? So I think that eventually you're going to have a lot of companies, a lot of capital coming to this asset class. Unfortunately for us, there'll be more competition. What I think it will happen is 2 things, right? I mean, I can tell you, and as Tony was saying, it's very hard to build working class multifamily or residential just because the numbers are not there. I'm part of a planning and zoning board of a city, and I can tell you that sometimes we struggle with the question because even though you can give CRA money and even land for free, just the numbers don't make sense on a risk-adjusted basis. It's easier to go buy something with 80% loan to value debt from the agencies and be cash flowing day one, then take a 2 or 3 year development risk where cities basically are throwing the book at you. So I think that there's going to be much more competition. The supply is kind of fixed on class B and C working class multifamily. So I think that there's a lot of people who are going to start thinking about the same way we're thinking, which is cash is cash and cash flow is cash flow. Why will we have to buy something in Miami at a 4% cap rate when we can buy something in Jacksonville at a 6% cap rate? I mean, Jacksonville is a secondary market, but it's a very strong market, right? We have a property in Pensacola that you can say it's a tertiary market, and it's performing extremely well. So I think that capital just basically like water just flow towards the path of least resistance. And the premise of cash flow on multifamily will become, I think, that one that will be highly appreciated by investors going forward. And so I expect more competition. There's a lot of dry powder inside.
I would both agree and disagree to some extent, and I think it somewhat goes to kind of our different views, as Dan talked about. He's doing a lighter value add with Class B, whereas our process really is to look for a more heavy value add. I think it's worth putting some numbers on the supply side of this. Basically, you've got you've probably got close to $500 billion of assets out there that are underperforming class B- through C- assets that could be purchased at a significant discount to ground up development costs and renovated. I think there's a lot of supply. Historically, it has not been viewed by the major suppliers of capital, the institutions, as a sector that they've gone into for a couple of reasons. One of which is it has been historically the purview of the local investor. The assets are highly granular at much lower valuations. And so putting together a scalable alternative has not been a great, or perceived to be by institutions, a great solution. So while there is a lot of dry powder, I think that the institutions need to start to have some thought process about how they're going to invest in scale in the sector. In the meantime, I think that there is a lot of property available. I think that it's almost always for us off-market transactions. We're going to investors that basically are running these properties the way you'd run a 175,000-mile car, which is they're just running them down through their useful life and using them as cash cows. And the result is that that's actually detracting from the stability and resilience of these communities. So to be able to go in and basically PV there, we don't really spend, I mean, we look at it, but our most important indicator is not the going in cap rate. It's really the subsequent stabilized yield value. And so as a result of that, we can give a pretty good present value to owners of properties that aren't particularly attractive, do a significant investment in them and bring them back to really a Class B with significant economics. And we're not seeing a lot of competition for that. So people talk about workforce housing, but they're not going after the more fundamental trade. And that's really where there's a huge supply in the marketplace.
Tony, I agree with you, but we're talking about two different kinds of risks right now, right? I mean, and you're talking to a guy who almost got killed, buying single family houses and managing single family houses. We actually were operators, we're more boots on the ground than Gucci's on the floor. So, for us, one thing that people talk about C-class and, let's do a full rehab and, deep value added, it's that's risk, right? And in some cases, these properties are not in the best neighborhoods, right? I mean, we had to airlift one of our employees because the guy got shot because of a gang initiation, right? And so there's a lot of friction in some of those C-class assets. And in some cases, the optimal debt structure is not there because, if you buy I agree with you. Sometimes it's better at a 3% cap rate that stabilizes at 7 than a 5.5 that stabilizes at 6. Right? But that doesn't make it very efficient because you have to come in with a bridge loan. You cannot go in with debt day one, right? So now you introduce another level of risk, which is, can I effectively manage this rehab process? And then in 2 years, I can trade my, bridge loan to a perm loan and what the rates will be in the future and so forth and so on. So listen, when we were buying houses at deep discounted, we love the trade. It's just that what we've seen so far is that deep value added, or at least the ones that we're running into, do not have the necessary discount on it to make it worth it. So we rather go with something that it's lighter value add, okay, that we can buy with an 80% loan, 10-year fixed, and provide our investors, maybe less of a cash on cash, but more secure, right?
I agree with what you're saying. Certainly, I mean, just by definition, every time you do anything new or add anything to anything, you get extra risk.
Sure.
But I think that what's interesting is we tend not to use the bridge loan technology. We tend to bake in to our process a longer term loan. So we take some of the financial risk out as well. We definitely are not looking at areas where people are getting shot. I mean, listen, people are getting shot on the streets of, towns all over the place, anywhere, but it's not to say that the random acts can't occur, but I think when you increase the size of your geographic region, you find that in fact, there are a lot of pockets of value. And I'll use an example. Property we've got in Newport News right now, which is a terrifically gentrifying area.
Yep.
But we have multiple properties there that we can go and purchase for going in caps of 4, 4.5, 5. but the expense ratios on the property are over 70%. So we're able to buy on a per unit basis, at an 80% discount to ground up development. Even with 100% value add, we're still greater than a 50%. And that's not a neighborhood anybody's getting shot. That's not that's a neighborhood where it's gentrifying significantly. And the fact that we're able to buy and then bring the properties back at median rents, so we're buying bottom decile rents and bring back median rents, means that we're actually creating something that's very affordable to the working class and continues to be affordable to the working class community that does still exist there, which is significant, and which is starting to see those properties erode for the more luxury properties that are being built in the area. So I think there are good neighborhoods around the country that you can do this trade in. It's also, but I will agree, you can't do it infinitely. And it's one of the reasons it's never going to be the purview of a Blackstone or a BlackRock or a KKR or one of these larger, because all of our funds, we put a cap on. We put a cap on it because we want to make sure that we get the investment in the right way. Now, that's still a very significant number. I mean, our fund that we're launching now, we're targeting just 75 to 150 million of raise, but we do have a cap on it above that because we want to make sure that we get all the investment done at the right time and then move on to the next pile of investments. We don't want to create a situation. I don't think it'll ever be the purview to move the needle for one of these companies. You need to raise a $5 billion fund. And I just don't think that it's that kind of transaction. So I do agree that there definitely is a limit on it. You can't just throw $5 billion at it. But I think you can, throw hundreds of millions and still be in areas that are quite good.
You'll be amazed. When we started buying single family houses, we never thought that Blackstone was going to go buy 80,000 of them. So, I mean, I think that eventually they'll probably will come in, but hopefully not. Hopefully not.
And that was interesting. So anyway, well, let's move on to the next question people have.
So I'll just ask Nate. Nate, if you have any thoughts on that last question.
Sure. I mean, I think I would echo, some of both of the sets of thoughts that were displayed. We probably operate somewhere between the two scenarios, and from a scale investment standpoint, from an institutional standpoint, we try to take the mantle of the institutional approach without, investing $50 million of equity at a time in a deal, although we're capable of doing that and have done it. I think that, number one, there's definitely a realization among the institutional investor base out there that we've been speaking to over the last couple of years of figuring out ways to get into this asset class of workforce housing, but time and again, they're functionally limited by the amounts of money that they have to put out the door quickly. And so, that was talked about a little bit, and Tony's perspective on kind of capping what they're doing in particular areas is similar to us having a cap of 100 million on our preferred fund, by virtue of the desire to put the money to work quickly and efficiently. The good news for, I think, all of us on this call within our geographies and within our assets that we focus on, there is an enormous amount of supply, and there's ways to be competitive in various different markets that where you don't have to go head to head with big institutions. The most competitive capital that's out there from our perspective in the Northeast, particularly right now since the pandemic, is just private capital and families that have a fairly long time horizon. So with our approach of kind of adding moderate value to properties, we're similarly able to get efficient long-term financing, but also get to a value add inflection point within a few years where refinance really brings back all or a significant chunk of the equity capital. And, within the deal sizes that we're focused on, we're able to pick spots where we know we're not going to be competing with major institutions. You get slightly better pricing as a result, and also doing deals that are big enough where it limits the audience of folks that can actually execute and close on that transaction. So I think about it as the sweet spot being sort of a, $15 to $20 million deal up to about 70 or 80 million, where you have the least competition.
Thank you, Nate. Another question from an attendee. With the shortage of housing, why don't more firms utilize the HUD's program since they offer 85% financing loan to cost? I'll open that question up to the panel.
We will use HUD's financing. We'll use that. I mean, the issue with using HUD is that you've got to recognize you've got an extended period to close. So if you're going to have to live with HUD maintenance requirements during the life of the loan. So just briefly speaking, it's great to look at the terms, but the terms that you think of as the general economic terms, LTV, rate, the kind of headline terms are spectacular, but the actual operating terms can be onerous if you're not somebody who's used to doing them. So we will do that. We know how to do it, and we're capable of doing it, but it's really not for everybody. And it also can extend your period if you're thinking about wanting to do a project and wanting to do it quickly and that being accretive and kind of needing that for the economics, in the short, medium, and or long term. It becomes somewhat onerous because it's 6 months to a year before you are actually actively doing anything on the property. You're spending the rest of your time really filing paperwork and preparing to do stuff on the property. And you're having meetings, all sorts of initiation meetings with HUD. That's not to take away from the program. And then subsequently, once you do the loan and start, you're going to have reporting requirements, and your actual boots on the ground construction teams are going to have operational requirements that are in addition to what you would use just even in best practices. Generally, you now have another set of hurdles to live up to. So there is additional complexity for the HUD program that doesn't, that does make it sometimes more onerous, either from a scale standpoint because you're doing much more and much more on much more, or even from a smaller standpoint where you're just a local operator and you're trying to do all this extra stuff that really is just purely extra operational. So it's something to think about. It's not a no-brainer to just choose that route.
Thank you, Tony.
Agree.
Another excellent question from an attendee asks about whether you all are focused on, when you're talking about workforce housing, more blue-collar workforce housing or sort of the new technology workforce that is increasingly coming into play, particularly in the COVID era, and also what do you look for geographically speaking? Are you looking for something close to the city center, near public transportation and the like, or more rural/industrial areas that may not be close to the city center?
So for us, it's a combination of everything. You have to have a good sources of employment and diverse sources of employment. Make sure that you're not really exposed to what we call the Detroit effect, right? I mean, if you have a city that only sells cars and suddenly cars are not being sold anymore, or the quantities that need to be sold, then obviously the whole workforce gets affected. So we're trying to be diversified on the macroeconomics of the city and to make sure that there is certain appeal to that geographical area where you have positive migration and not negative migration. As far as being close to the mass transit, Waymo just launched last week in Phoenix a total self-driving car. Tesla is launching today the full self-driving stack. So I think that in 2-3 years from now, that'll be relevant. I think that you're going to have self-driving Ubers, cheaper than buses and more convenient. So for me, the most important thing that we're looking for, more than convenience to a bus stop, is make sure that we have solid economics of the city, of the neighborhood, safe neighborhood where people like to come and live. Ideally some sort of decent scores on the school system. But at the end, it's a combination of everything.
Thank you, Danny. Danny, if I could stick with you as well for this next question, and you certainly talked about risk, both physical risk and economic risk. But what are generally the risk factors that you analyze when evaluating a potential multifamily acquisition?
So we started buying houses one at a time, and that basically allowed us to grow our platform and to understand how things work, right? So when we were rehabbing our 400 house, you'd think that the budget's going to come on budget, and there's always surprises, right? So one thing that we understand is that the more rehab that something needs, the more risk you have, right? So the second part is, what is the upside of those rents? In my case, the way we look at it is those upsides have to be proven, right? You just cannot say, well, you know what, if we're going to install granite and stainless steel appliances, then rents will go up, right? There's a lot of fluff out there from the brokers. If you install a dog park, then suddenly you can charge $100 more. So for me, those things are not really play into our framework or analysis. We're very data oriented. So we see a lot of ugly properties and things that don't fit in order to buy one. So when it comes to data, we have a lot of data. We hire into our platform people that have gray hair or no hair because they've gone through a couple of cycles and they can bring a lot of the experience to the table. And so when we sit down and look at things, we simulate what will happen. We sort of stress the model. We identify what are the elements of risk, right? So we bring to the table people who can tell us how much the taxes are going to be 2 years from now. We bring consultants to talk about insurance. We look about, flood levels, what can happen, what can be done. And one of the things, the goals that we want to get from this is to be able to tell our investors, this is a 10% cash on cash, net of fees, and you can take that money to the bank because we've underwritten it in a way that it's conservative, right? So I think that there's a lot of risk that people are not really seeing in any industry, and we try to identify that. What is the risk of refinancing with people going through a bridge loan? There's somebody that's using out there a lot of the financial engineering. So the numbers look good, but they all depend on year 3 going for a refi of the property or a secondary loan. That's a risk. So one of the things that we know, again, comes back from my financial background, is risk plus risk is not 2 risk, is risk squared. So you have to be very cognizant about what your risk are and how it affects your model.
Thank you, Danny. And I'm sorry, did somebody want to jump in?
Tony, I would say that Danny's getting it spot on. Quite honestly, that question is a great question, and it could be an hour all by itself talking about the risks associated with real estate and with multifamily and what we all look at, because I think that that's the definition of doing any transaction, making any investment, is you spend all your time looking at the risks. I think all of us are heavily experienced on this call, and what experience teaches you is that you work hard, and through the efforts of hard work, the upside kind of takes care of itself. But the risks associated with something are what you have to actually identify at the beginning and then work throughout to mitigate and or hopefully eliminate. That there's just no way around that. So there's all these pieces of risk. I think one of the pieces that Danny started to talk about has to do with rent ranges and understanding that while we're looking for thriving communities, and I think this applies, and I don't want to put words in anybody's mouth, but my guess is, and I don't like the term workforce. We actually try not to use the term workforce. We use the term working class because we're specifically going back to the question before, looking at people who are between 60 and 120% of area median income. And so we're looking to create going out properties that are serving affordably that class in terms of the rent levels. But importantly, what that means is that we're not building for some or creating properties through value add, any of us, for people that don't already live in these communities. We're not creating, one of the major risks in real estate right now to get returns is that people are doing things very prospectively relative to the communities. They're either betting that the community itself will be something different, or the community members are going to be somewhat more affluent through a set of events that are going to occur to either bring in new members or make the people there more affluent. And as a result, they're creating properties prospectively that have rents that are above what the current communities can pay. And I think that's the single greatest risk associated with real estate right now, whether that be in major markets or in secondary markets, is that you're trying to serve a rent range that isn't there currently. And I think that when we talk about whether it's working class or workforce or whatever, we're looking at serving existing populations who can pay the rents that we're going to charge. So it becomes a lot less risky because you're dealing with people who are there. And I just think that's worth pointing out, because I think that's a major differentiating factor between what all of us are doing on this call and what people are trying to do to squeeze value out of, or potential, or at least show value potentially out of projects in other types of sectors.
Yeah, and one of the things that I think it's important is that the broker community is taking advantage of this gold rush and, starting to push things that, everything's a value added, right? I mean, I was once touring a property and the broker is like, yeah, you know what, it has white appliances and you change them to black, you can increase the rent. And then, the next day our broker is like, yo, it has black appliances. If you change them to white, you can increase the rent, right? I mean, everything is like thrown in there and see what sticks. And I cannot agree with you more, Tony. One of the things that we look at is when people said, okay, this is what the rent's going to be. The first thing we're going to be looking at is what's the median income of the area. So that's one of the most important factors.
Well, thank you. We're quickly approaching the end of our panel, so I think attendees want to hear about any distressed or discounted opportunities that you all may be seeing, and maybe you each could spend a minute or so on where we are in the cycle given COVID. Do you see the market deteriorating further, stabilizing? Nate, why don't we start with you?
Sure. So this has been an interesting thing that's still evolving, but a few months back, earlier in the pandemic, I think that virtually every conversation I was having with a prospective investor was one where they were focused on, do you have a distress opportunity for me? When are you going to have a distressed deal? And even back then in the early stages of that expectation, I was telling those folks that I don't expect to have any. And so, we knew very early on in this environment that our asset class was outperforming, and our markets were outperforming, and the types of investments that we would make and continue to make were relatively insulated from a lot of economic shocks, including this one, as it turned out. Collections in our markets bottomed in April and May, and have been back at pre-COVID levels since August. And so between the readily available agency financing, which was talked about previously, the amount of appreciation that's occurred in this latest economic cycle, and the ability for folks to refinance even properties that may not be performing that well, given how low the rates are and where the debt service shakes out, and if they didn't start out over levered, or they didn't start out with a business plan that didn't make any sense to begin with, most people are doing okay. And I think in the panel before us, there was a slide that showed something like only 2% of CMBS loans in multifamily were in special servicing. And so, that's just another indicator of lack of distress in the multifamily space. And I think that's going to continue to be the case primarily in the workforce housing space, but I think you're gonna start to see some cracks in some of the higher end luxury, overdeveloped markets that are out there and overpriced markets that are out there. I personally live in Manhattan and see firsthand, rent drops of 15 to 20% in Class A apartments pretty readily. But then again, most of those assets are owned by institutions that can weather a storm for a little while. So I think where the distress is going to come, it's still several months off. If it happens at all in multifamily, it's with smaller operators that had value-added business plans that didn't make sense, that were over-levered, or it's people that got into a development with the wrong timing and planned to build condos and now they can't sell them, or had a lease up that got truncated by the pandemic and they ran out of time on their construction loan and they can't refinance at a basis that makes sense.
Thank you, Nate. Tony, Danny, any thoughts on seeing distressed or discounted opportunities in the multifamily market?
Yeah, we had a property under contract April. It's obviously it's the middle of COVID, and we have it on the LOI, and we're trying to get a PSA that has all the rights of us trying to get into all the units and so on. We got stuck in the details of it, and at the end we couldn't get on the PSA, and it was under distress because somehow the owner needed to sell. And again, in April was different, but we didn't know we were going to need to use hazmat suits just to get into the units, right? I think that the COVID sort of fears of have a little bit died down, and for the contrary, people who own residential asset classes understands that right now there's an opportunity. I agree with Nate that the opportunities will come back from specific people who cannot perform, not from the asset class. There's a contract to 2009 where there was basically no capital on the sidelines. There's a lot of capital on the sidelines, right? You'll see out there the distressed single family borrowers who are under dependence. That's increasing, but that's obviously it's going to come down and not put that much pressure on the asset class. So I don't think that a lot of those things we will see distress, but we're always looking for someone who's under distress, but it's very, very, very hard to find something.
Yeah, I would agree with that. I think there's a lot of forms of distress. I will say that I'm not particularly sanguine about this next 6-month period. Not so much, again, from our standpoint of the fundamentals of rent and income and cost structure, as much as generally from the market. I think we're in for a bumpy 6-month period. So I think there's some risk. I think there'll be some distress. I think that for people who are not in the industry every day, they're only going to read about distress. Right? I think that's one of the things that people have to gird themselves for, is that if the macroeconomic situation, if the pandemic, if the next 6 months is difficult, then every headline, whether it be in our sector or not, is going to be about distress. Nobody writes, oh, rents were unchanged and collections were unchanged. It's just not news. What news is that luxury rentals in New York are 40% delinquent and rents are down 20%. And there are going to be enough of those stories for people to write that it will appear as if the sector is in distress, even though at the level that we're talking about and the properties that we're talking about, I don't think we're very likely to see particular distress. The flip side, of course, is that you can make an argument that the assets that we're focusing on, of which there's a significant supply at very extreme discounts, which are somewhat just intrinsically distressed because the housing stock is aging. So the opportunity to buy as the housing stock continues to age and as there isn't the ability to create new ones, I think there'll always be the opportunity to buy low priced assets. And I think this next 6-month period is going to help us do that. So I don't know that there's necessarily going to be fundamental distress, but I think there's going to be macroeconomic and headline distress, which will enable us to buy assets more cheaply.
Are any of you concerned about additional governmental policies or programs such as moratoriums on evictions and foreclosures and the like. Have those COVID-related governmental rules impacted any of you? And are you concerned about additional such policies going forward in the future?
I will tell you a couple of things. I'm very concerned that the government is kind of taking this blanket statement and say, you know what, if you cannot afford rents, don't pay them. Just to give you some sort of data, right? In the single family arena, 97% of single family stock, and I think the number is 15 million, it's owned by mom and pops, right? I think that in the multifamily, I think it's only 55 who's institutional. The other rest is mom and pops. So at the end, the institutional guys, we have, good reserves. We are financially responsible. We are going to be able to weather the storm. This concept of, the landlord, it's a bad actor, taking advantage of the poor people. We have to be careful with what the message we project to the actors in this arena, because the last thing that can happen is somebody not paying the rent to that old lady who's living out of that rent check, right? And now that old lady who's living out of that rent check cannot afford to, feed herself, right? So if the government is going to enact something and it's going to come some sort of as a political statement, it's the same as saying, well, if you're hungry, you can go to a restaurant, eat, and don't pay the bill, right? So we need some sort of checks and balances to make sure that the whole sort of industry doesn't really start to suffer from this. Having said that, right, we know that this is a blip, and when you're underwriting rents in a 5-year hold, maybe this is going to be a 6 months to a year. And one of the things that happened was that when this started, I think everybody in their mind were like, well, okay, 50% I'm going to pay the rent. We already know that the number is more like 3 or 4%, which is manageable. So although it's going to affect, right, I think it's safe to say that you can underwrite it, you can weather that storm and come out pretty much unscathed on the other side.
Yeah, I would support that at the lowest level factor. What we found is that the people during this pandemic who are taking advantage of that, and I, by the way, I think it's really, again, worth distinguishing between the working class workforce housing world and the Class A housing world. The Class A housing world is actually having a much more difficult time with this.
Sure.
Right? The Class A housing world actually is having an issue because people are really taking advantage of it in a way that is dramatically different. And that's throughout the major metropolitan areas around the country, center of that. But in the workforce housing, what we've seen in our property is that the people that are the people that were problematic payers originally continue to be the issues, and the people who are having subsequent problems, who are looking for some level of cooperation with us as the owner and with the property managers, who can't pay, they're paying 95%, or they're still paying a huge chunk. One of the reasons the payment rates have stayed so good is that what we're seeing is that people who are just have less income or have some sort of limits are still doing their best to pay.
Tony, I have to apologize. The time for this panel is up. Guys, thank you so much for doing an excellent job today. I need to move on to the next speaker at 12 o'clock. But you did an excellent job going into a lot of granular detail that the audience today wanted to hear from. So thank you. Thank you, Matt. Thank you, Danny. Thank you, Tony. Thank you, Nate. And best of luck to you in your firms.
Thank you.
Michael.
Thank you, Mike.
All right.
Bye-bye.
All right, guys.
Thank you.